Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
A call is something that gives the buyer the right but not the obligation to purchase something at a price by a specified date. A put is a much more bearish position. The strike price in that regard allows us to, it dictates the price that exists within that capacity. Implied volatility, we hear a lot talked about that in terms of, and implied volatility is basically the perception of the future standard deviation of that underlying market. We hear about expiration months. Well, just like the strike price plays a value in the option, the expiration month does as well. Ultimately, the intrinsic value, when we talk about that, it refers to if the option were expired today, what would it be worth? So if we have the EUI or the Euro FX ETF, if it was traded at 83, the options for the 80 strike, well, there's $3 of intrinsic value built into that. So you'll hear me talk about that. And then lastly, we're going to just touch on the four Greeks, the delta, gamma, theta, and vega. Those are the four large Greeks that make up and compose the price of or at least effective value of the option over the course of time. And briefly on the delta here, because again, this is a gamma trading, so they all kind of wrap back into the whole presentation here. The delta is, if you have an at-the-money call or an at-the-money put, meaning at-the-money, the EUI is at, let's say, 80, all right, or 75, okay? Well, the at-the-money would be, the 75 calls or the 75 puts. Well, the delta on both of those is going to be at 0.5, meaning if the underlying stock rose by $1, the delta would rise by 50 cents. And the gamma, which is something that you hear, obviously, gamma trading when we talk about this, is that what's the rate of change of the delta? So it's like the derivative of a derivative, meaning that, okay, if the delta moves from 0.5 to 0.6, so let's say the stock goes from 75 to 80. Well, the delta, the at-the-money calls at 75, it's probably going to go from 50 to maybe 65 or 68. Well, that 18-point bounce in the delta is what the gamma creates. That's the gamma change, or the rate to which the delta changes at that point in time. The theta refers to the time value of the underlying option. So we have 5 days left, or 10 days left, or 15 days left. How fast will this option decay in time value over the course of time? Now, what we see with the theta value is that the closer we get to expiration, the decay happens at an exponential level. So it's not a linear process at all. It actually increases exponentially towards expiration. That's something we keep in mind as we hit up some of these strategies here. Some of that will make more sense. And then lastly, the vega or volatility, meaning what happens to the price of that option if volatility picks up by 1% or 2% or 3%. And I have some option software that'll provide some more lucid examples of what I'm talking about. I know I'm speaking some abstract right now, but overall, there's a method behind this madness, and we'll show you some real-world examples to further articulate this. Okay, some Forex option strategies that we're going to talk about over the next few minutes here. Synthetic calls and puts, which are some of my favorite. Straddles, which I love, is as we talked about earlier, that's a pure implied volatility play or long volatility play. Strangles accomplish a similar component. Calendar spreads, which are something I like to use, also work on that dynamic, whether bullish or bearish short-term volatility. It's a way that we talked about. Maybe you want to sell volatility. This may be a way to go and do that. Collars work very similar to call spreads and put spreads, and we'll just touch on those and hit some various examples along the way. All right, synthetic calls. I talked earlier about what a call, what a put is. Well, synthetic call functions in the same way as normal call does, except I'm a guy that drives a lot of feel, being aware of the price action in the market. So by a synthetic call, I mean that I'm long the underlying and I'm long a put. All right, that acts as or facilitates or is structured and produces the same P&L as if I was just long the call itself. And so people might say, well, John, why would you be in a synthetic call? Why don't you just be long the call itself? Why create another leg? And I'm a person that by being long the underlying, I get to internalize the price action a little bit better. So it does create a little bit of an extra expense by putting it on this way. If I'm going to be actively gamma trading this market, I like just seeing the movement of the underlying. I like internalizing one more process to provide me some more insight into the overall scope or feel of the market. So in this case, I want to be long the yen, the ISFX yen, the symbol YUK, and I'm also going to be long a YUK put. And as a result of that, if the market goes up, This is a bullish position, obviously, because it's a synthetic call, and if the market goes up, that's clearly my posture at that point in time. Conversely, if I want to be in a synthetic put position, it means I have a bearish position out there. So with synthetic puts, we're short the underlying while owning the call. So we're short the YUK ETF and long the YUK call. And that again functions that if I think the yen is going to head down, but I wanted to find my risk, that's a good way to do that.
So John, what I could do then is if I'm trading in the spot market, and I have an account at someplace like IB or somebody that can take my spot trades, then I could actually buy like the U.S. dollar yen, and then buy a put, which is like you said, basically a synthetic call on that YUK, correct? And then you're more comfortable in sort of trading that back and forth. And
that's the point behind this, is that by having that exposure, we've compartmentalized and defined our risk. With all this volatility we've seen recently, a lot of people say, how can you trade these markets? How can you trade these markets? Well, by trading that spot around these options, you really put yourself in a much better situation to handle that. So moving forward to the next option strategy. Now, this is what this would look like. On a graph here, we see from an option software standpoint, if we were to get into this position, we see that our max loss here is defined at minus $20,000, and this is for the synthetic call position here, and our max gain is in theory an infinite amount of money. So that's how that can be structured, and that's what that looks like on a P&L chart.
Hey John, so if I thought vol was low last year, I could have probably bought any option and hedged it and probably did all right. Is that what you're sort of showing here?
Absolutely. No, Stephen, you hit the nail on the head, because when you were gamma trading like this, and we'll hit this a little bit later, but what goes on is that with all this range and all this movement, the delta of our underlying position adjusts much, much faster than the underlying pricing of that option is caked in. And so even if just by going to delta neutral with this range, there's been so much range and so much volatility that you more than pay for your time decay, you more than pay for the premium in the options, you more than cover your intrinsic value. And that's and that in a nutshell is the gist behind, if volatility is too low, the range is going to be higher than what the option's priced in, at least if the market's priced in volatility being too low. And if volatility is priced in too high, then the underlying then you want to sell the underlying, because the range will not catch up to the rich premium that's built in there.
Well put.
Okay. Now the next thing, and again, you talked about buying any option, but let's look even further here, and on the straddle leg, and that's to be long a call and long a put at the same strike price. It incurs a deficit to the account if long, a credit to the account if short. And clearly, if like we talked about the last year here, this is a market you want to be more long straddles than to be short straddles. To be short straddles can cause a very nightmarish situation, because clearly, when you're short a straddle, your losses are unlimited to the upside and obviously capped to the downside. But nonetheless, this has not been a market you want to be short gamma in this case if you're short straddles, or long. It's very much a market you want to be long gamma or long volatility. And again, like we talked about with any option trade out there, if you believe volatility is priced too low in the market, then you want to be long, and too high you'd want to be priced short. So long the EUI straddle means for a trader to own the puts and calls for, in this case, for a combined premium of $8,100 per straddle. And I'll show you the options chart that I had to take my options software with, and unfortunately use for my options analytics I had to use a different exchanges pricing data, but I want to convey and give you guys an accurate P&L chart here. And this is just simply on one EUI contract. We see it's going to cost about $8,000 to put this on just for one contract apiece, and you see the wide range here. But that is our max loss. Now, one benefit that I derive from trading straddles, I trade a lot of straddles, both long and short, is that when I'm long a straddle, it really compartmentalizes my risk. It really lets me know what my stop loss is going to be for that particular month, and that's very important when it comes to managing risk, when it comes to assessing one's portfolio profile. So if, in this case right here, 147.5 for the spot Euro FX is the area that I think that we're going to either break higher from or we're going to break lower from. I can trade long or short all month as long as I never get higher than my actual initial contract size. And no matter what happens that month, the most I can lose is the amount that I paid in premium for that straddle. And that's a nice backstop to have when you're trading a volatile market. And that's a way that, if you're developing a trading plan and you want to say, okay, I want to trade with a 4% stop loss every month, and I'm a guy that likes to play breakouts and I like to play big moves in the market, well then maybe looking at putting a straddle component into play is a great way to help you truly follow your trading plan, because you can never lose anything more than what that amount is based on the way the straddle is set up. So it's a nice way that every month, okay, I risk 3% a month or 5% a month or 8% a month, whatever your own personal comfort level is. It's just a great way to follow that plan and follow that discipline, and it gives you now a tool to look after that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.